Hey everyone, welcome back to the channel and welcome to episode 2 of a three-part sponsored series by Global X Canada, who I'd like to thank for sponsoring this series. So in case you missed it everyone, episode 1, which is this video here, I focused on reviewing the newer growth-oriented ETFs that Global X Canada has launched this year and really put them together with the entire growth lineup. So in this episode, we are going to cover, very excited about this, the income-oriented covered call ETF. So Global X Canada has been very busy this year. They've launched a whole bunch of new index-based covered call ETFs, some fixed income ones as well. So we're going to take a look at them. We're going to review them together in this video. So we're going to review actually over 20 ETFs in this video. By the way, not all of them are brand new. Some of them have actually celebrated their 1-year anniversary, but we're going to check out the new ones and really put them together so I show you really the complete lineup. That is my goal of this video, to really showcase the complete lineup of income-oriented covered call ETFs that Global X Canada does manage. So let's get started. I'm going to separate this really in 3 parts. First, we're going to look at the index-based covered call ETFs. Then we're going to look at the sector-specific covered call ETFs. And then lastly, the fixed income bond covered call ETFs. So let's get started. So we're going to start with the index-based covered call ETFs. Very, very popular way of investing, right? You are basically buying an index, which means instant diversification across multiple sectors typically. And these are very, very popular indexes as well. So in case you want to follow along, if you go to Global X Canada's website and click on our ETFs, the easiest way to find them with the search is just put in covered call and you'll pretty much get all the covered call ETFs here. So we're going to start again with the index-based one. So first, you have USCC. This is not one of the new ones. It's been around for more than a year. You have USCC, which is the Global X S&P 500 covered call ETF. So it's essentially the S&P 500 index with covered calls. You see the yield there, the yield based on July 18th stock price, over 10% yield. And in case you didn't know, and by the way, this ETF, you could buy it in Canadian dollars, but the dividend, the distribution actually is paid out in USD currency. They also have a .U version of USCC, which means you could actually buy this in US dollars and get a US dollar dividend. And then they have a leverage version, and this is where it's basically USCC with 25% leverage. That's why you have the enhance here. So this is going to be a very common thing that Global X has done, Global X Canada has done. They typically have the first 3 letters of the stock symbol, and they just switch the C to an L for the leverage version. So if you actually look at the holdings, you pretty much see the Global X S&P 500 covered call ETF, which is USCC, but you see the percentage as 125%, which means this fund uses 25% leverage. So USCL recently actually celebrated its 1-year anniversary. That's why you have the yield here. And obviously, if you're adding 25% leverage, you are going to get more yield as well. You see the difference here between the leverage one and the non-leverage one. Of course, by taking 25% more leverage, you got to expect more volatility as well, right? So S&P 500, right, guys, a very, very common and classic way to invest, of course. So you have your 3 options here. With USCC, USCC.U, and USCL, the leverage version. Moving on, you have the NASDAQ 100, another very popular index covering US stocks. This is NASDAQ 100, so very, very technology focused. You have QQCC, not new. It's been out for over a year. You see the yield here, 10.62. Of course, based on the July 18th price and based on the current distribution, which has remained a fairly solid and steady 10.75 cents a month. And now you have QQCL, of course. QQCL is a newer ETF, which is basically QQCC with 25% leverage. Moving on, you have CNCC, which is the overall Canadian market. It's tracking the TSX 60 index, which is basically 60 most important, biggest companies in Canada. So you have CNCC and, of course, CNCL, which also recently celebrated its 1 year anniversary, I believe, which is the leverage version, or 25% leverage of CNCC. Moving on to some of the newer ETFs now. So of course you have US with S&P 500, NASDAQ. You have Canada with the TSX 60. What's missing? Well, it's international developed exposure, and one of the most popular indexes to get that exposure is the MSCI EAFE covered call ETF. So this is a index-based covered call ETF which focuses on the regions outside of North America but that are developed. So things like France, UK, Japan, Australia, Switzerland, Germany, Sweden. So you have developed economies outside North America. So this is a brand new ETF here, EACC, everyone. So if you want that exposure in an index form, but with covered calls, which means you'll get monthly distributions, you have EACC, and of course EACL is the leveraged version, which of course simply holds 125% of EACC. And another new one is the major, really popular 5 indexes, I would say, is EMCC, and this covers emerging markets. So we all know what emerging markets are, right? It's economies like China and Brazil, Vietnam, things like that. So you have EMCC, you get your emerging markets with monthly income thanks to those covered calls. And like you probably guessed, that they also have a leveraged version called EMCL, which is EMCC with 25% leverage. And in the leveraged version, you'll see pretty much the same name, but you'll always see the enhanced in here. So that is 5 very, very popular indexes. Now, if you don't want to pick and choose, they have another option called EQCC. This is a newer ETF as well. So EQCC basically combines those 5 covered call ETFs in one package. So it essentially means you're getting access to some of the best stocks all around the world, like the name says, right? All equity, all stocks, asset allocation. So if you just look at the holding, it's basically those 5 ETFs, and you have the percentages here. So you'll get the S&P 500 and NASDAQ 100 for your US exposure. You get the TSX 60, which is CNCC, right, for your Canadian exposure. And then you got some emerging markets and the EAFE as well to give you really, best stocks all around the world. And like you probably guessed, they do have a leverage version as well, EQCL. And I just have this open here because EQCC is kind of the covered call version, you could say, of HEQT. So HEQT is the all equity asset allocation ETF, which has been out for over a year without covered call. So this is kind of like a growth version of EQCC, or you could say EQCC is the income or covered call version of HEQT. And by the way, HEQT as well as the other growth ETFs they were all covered in episode 1, so make sure to check it out if you're interested in some growth options as well. So yeah, EQCC, whole world with covered calls, basically. EQCL, the leveraged version, right, of EQCC. So you got that 25% leverage. And so EQCL is basically a covered call or income version of HEQL, right? So HEQL, I could probably guess it is a leverage version of HEQT. So hopefully I didn't confuse you, but that is really the nice lineup of income-oriented funds now that are all index-based, very, very popular indexes, right? The S&P 500, the NASDAQ, TSX 60, et cetera, et cetera. Now they completed the lineup with the emerging markets and the developed outside of North America. And if you don't want to pick and choose, they got a phenomenal, great all-in-one option with EQCC, or the leverage version of that, EQCL. So now let's move on to the sector-specific covered call ETFs. All right, everyone, in terms of sector-specific covered call ETFs, Global X currently has 6 of them. Let's go through them, starting off with BKCC, the Global X Equal Weight Canadian Bank covered call ETF. So just like this name says, an equal weight of a Canadian. Big 6 banks, you see them here, right? The big 6 banks with covered calls. And if you just turn this C into an L, you have BKCL, which is the 25% leverage version of BKCC. So it's very simple, just like the index ones, right? The leverage one will hold approximately 125% exposure to the non-leveraged ETF, which in this case is BKCC. So great option if you want to invest or looking for exposure to the Canadian banks with covered calls. They have an energy one, so ENCC is the next one, the Global X Canadian Oil and Gas Equity Covered Call ETF. So if we look at the holdings, you really have some of the big blue chip, not only oil and gas producers, but also the pipeline. So you'll recognize a lot of these companies, I'm sure. Big oil and gas producers like Suncor, Canadian Natural, Imperial, Cenovus, etc. But you also have the pipelines in here, which is, could be a good diversification within the energy sector. So of course you have Pembina, TC Energy, the biggest one, Enbridge, and Keyera as well. So a nice mix of energy here, gas producer, oil and gas producers, and pipelines as well. And just like BKCC, there's also a leveraged version of ENCC. Like you probably guessed, it's going to be ENCL, which just holds approximately 125% exposure to ENCC. So next one is the gold producers, GLCC. There's no leverage on this one. So this is going to be, just like the name says, your top gold producers out there, very high quality. So you'll recognize a lot of the names here: Barrick, Newmont, Goldfields, etc., etc. So you got your gold producers here. There's no GLCL out yet, by the way. So there is no leverage version of this ETF out yet. Last but definitely not least, you have HGY. So this is the Global X Gold Yield ETF. So unlike GLCC, which gives you access to the actual gold producer, the companies or the stocks, this one gives you exposure to gold bullion, right? Gold bullion. So this obviously is going to have less volatility, most likely, right, than the gold producers. So this is really if you want access to that gold bullion. So if you look at the holdings, it actually holds the GLDM ETF, which is pretty much the biggest ETF that gives you access to gold bullion. So that wraps it up for the sector-specific covered call ETFs. Now let's take a look at the fixed income ones. All right, everyone. So let's take a look at some of these fixed income, income-oriented ETFs. So just a quick trick that I figured out here. If you want to search for all of them, check them all out. When you go to our ETFs and you'll get the search, just put premium yield and you'll get them here. So you have SPAY, MPAY, LPAY, and their latest one, PAYS, PAYS. So let's go through them one by one. Obviously, if there's a .u versions, it means you could buy and sell them in USD currency. So and as far as the non.u version, so SPAY, MPAY, and LPAY, just a note that for these three specific ones, you buy them and sell them in Canadian dollars, but for all three of them, the distribution that's paid out is paid out in USD, in US currency. But remember, just like USCC, that it is typically automatically converted into Canadian dollars in most Canadian brokers. There are some exceptions, of course, like Questrade, for example. So you'll have to check with your broker to really learn how that distribution is going to be paid out. But SPAY, MPAY, and LPAY, although you buy them in Canadian dollars, just like USCC, the distribution is paid out in USD. But if you have depending on your broker, it's typically automatically converted to Canadian dollars. So you'll have to follow up with your broker to figure out how that's going to be paid out. So let's go through them one by one. So SPAY is the short-term US premium treasury yield. MPAY is the mid-term, medium-term, and then you have LPAY, the long-term. So all three of these invest in US treasuries or US government bonds. The main difference is going to be the duration, obviously, right? Short for SPAY. Doesn't take a rocket scientist to figure it out. Medium duration for MPAY, and LPAY is long duration. So obviously the longer duration you have, the more duration risk you have as well. So SPAY, if we look at the holdings, everyone, most of the exposure is in this ETF here, the Global X 0 to 3 month US T-bill ETF, which is basically this one here, ubill.u. So this is a very, very short dated US treasuries. But you'll also see an approximate 10% exposure in TLT, the iShares 20 plus year treasury bond ETF, which is this ETF right here from BlackRock, from iShares, which is the biggest, by far the biggest US government bond ETF, everyone. So that this combination here, by having a little bit in TLT, and most of it in the 0 to 3 month basically makes it short-term duration. So all three of these, by the way, have monthly distributions as well. And if you actually scroll down and look at the details, the portfolio investment metrics, by the way, you could actually see the average weighted duration, and obviously the less duration risk you have. So of course, SPAY, which is the shortest, only has an average of 1.82 years, which is fairly short. Then we go to MPAY, which if we look at the average duration, obviously is going to be higher at 6.83 years. And if we look at the holdings, you have 60% in the 0 to 3 month, and you'll have 40% in TLT. So the combination of that gives you a midterm. And then, like you probably guessed with LPay, if we look at the holdings, you only have 20% in the 0 to 3 month, but you have most of the assets in the long-term ETF TLT, but also 30% in VGLT. So combined 80% in long-term U.S. bond ETFs. And if we look at the average duration, of course, it's going to be the longest out of the three at 12.86 years. So that's it for the U.S. government ones. So again, SPAY, MPAY, and LPay. And again, there's .U versions for each of those. If you want to buy them in USD currency and get the distribution in USD currency, you get that with the .U versions. But there's also PAYS or PAYE. And like you probably guessed, it really focuses on Canadian government bond, right? So this one is kind of unique because it does covered calls and also some puts. So it could do calls and puts as well, like it says here, put and call coverage. And that's just going to be based on market conditions. So if you actually look at the holdings, most of it is, or 90% of it approximately, is going to be in the Global X 0 to 3 month T-bill ETF, which is this one right here, C-bill, basically. So Canadian government bond, short exposure. But you also have approximately 10%, again, once again, in TLT, the U.S. long-term government ETF there. So if we look at there's no duration details yet, but pretty much the average, as you could tell, is going to be fairly short duration, right? Because almost 90% or about 90% is really in the 0 to 3 months. So now we have an option for Canadian government exposure here with some income, with calls and puts with this one here. So that's it for the fixed income ones, and that pretty much wraps it up for going over now the entire lineup of income oriented ETFs from Global X. If you have any questions, let me know in the comments below, and see you next time.